Welcome to ESOPs Decoded, the high-stakes game of employee ownership. This video is your comprehensive guide to understanding employee stock ownership plans. We're going to break down how ESOPs fundamentally shift an employee's role from a simple worker to an actual owner. This transition from a salary mindset to an ownership mindset is crucial for high-growth companies. ESOPs are designed to turn employees into long-term value partners, aligning their financial success directly with company growth. Startups leverage ESOPs to attract and retain critical talent, especially when competing with higher cash salaries from larger corporations. So what exactly is an ESOP? ESOP stands for Employee Stock Ownership Plan. Simply put, an ESOP grants an employee the right to buy a specific number of company shares at a predetermined, often low, strike price. Crucially, this is not free equity. It is a future ownership opportunity tied to the company's performance and the employee's commitment. In early-stage companies, ESOPs often function as a substitute for a high cash salary, offering potential exponential returns instead of immediate cash. The core design of an ESOP is about aligning employee interests directly with the company's need for long-term growth. When company valuation increases, employees benefit. This encourages long-term thinking, performance accountability, and creates a skin-in-the-game culture that reduces attrition. Next, let's walk through the 4 key stages of the ESOP lifecycle. These stages are the grant, the vesting period, the exercise moment, and finally, the sale or cash out. Now let's look at the incredible upside and wealth creation potential that makes ESOPs so appealing. Stories of early employees at companies like Google, Infosys, and Tesla becoming ESOP millionaires highlight the exponential returns possible from early equity. Beyond the financial potential, ownership also drives increased productivity. Plus, one major benefit is tax deferral, as you don't pay tax at the time of the grant, allowing your equity to compound growth tax-free initially. But there are significant risks. We start with the bad, beginning with a common danger, the tax trap. The crucial perquisite tax is often due at the time you exercise your options. This can create a significant cash flow demand before you've actually sold the shares for cash. This is a red alert scenario for many employees, needing to pay substantial tax bills based on perceived wealth before that wealth is actually realized. Next, let's cover liquidity and diversification, 2 major risks in the ESOP journey. In private startups, your shares are often paper wealth. They cannot be freely sold until a major liquidity event, like a company buyback, an IPO, or a secondary sale to investors. Your options for cashing out include a company buyback, a secondary sale to investors, or the ultimate goal, an IPO. But there is no guaranteed timeline for any of these. A critical warning is diversification risk. You are tying your salary, your professional success, and now your retirement savings to the fate of a single company. This overexposure risk amplifies during economic downturns. Sensible employees should diversify gradually, but only after they have realized cash from a liquidity event. Finally, let's address the silent killer of equity value, dilution. Every new funding round increases the total number of shares, which means your percentage of ownership shrinks, or unless the total ESOP pool expands proportionately. Both founders and employees share this burden. Dilution primarily happens when new investors enter, when the ESOP pool is refreshed, or when significant equity is allocated to new senior leadership hires. It is important to remember that owning 1% of a company before a Series C round is very different from owning 1% after a massive unicorn valuation increase. New funding rounds are necessary for company growth, but they are also the primary mechanism that reduces your initial ownership percentage over time. However, dilution doesn't automatically mean a loss of value. The ultimate value depends on the company's growth, revenue, and eventual exit multiples. New hires, especially senior leadership, also impact existing ESOP holders through allocation from the option pool. When senior hires receive a significant ESOP allocation, the existing pool expands, resulting in a slight dilution of early members' stakes to accommodate the new talent. Finally, let's move on to the most important part, how to negotiate and evaluate your ESOP offer. An ESOP should never be treated merely as a perk. It must be evaluated with the seriousness of an investment deal. Key negotiation variables include the strike price, the vesting schedule, the exercise window, the company's buyback policy, and the probability of a successful exit. The core dilemma remains: How do you evaluate an ESOP package against a higher base cash salary in a year like 2026? You must consider the company's current stage, its burn rate and path to profitability, the current market environment, and the clarity of its exit roadmap. A smart strategy is to push for an ESOP heavier package in the early stage and balance it with more cash at a later, more stable stage of the company. ESOPs are a high-reward, high-risk game. Understand the mechanics, manage the risks, and negotiate wisely to turn paper wealth into actual financial freedom.